research online last night, as I like to do. Price of a Freddo in year 2000, what do you reckon?
The markets have really fallen. Those clients have now seen the benefit of staying invested in the markets because those markets have gone back up. Yeah. There's been growth on there with, from Paul and his team, which is, alluding to the diversification, how it manages inflation, how it manages
Good morning, everyone. Good afternoon, or whenever you're watching the podcast today. Welcome to the Do More of Your Money podcast. We're on episode 102. Yes, 102. I was on 101 last week, so I do know that I did expect that. I'm going to keep using this joke until Greg tells us that I can't use it because it's not funny anymore. But great to see everyone today. Got a great session planned today. We're talking about how money can be affected around inflation, interest rates. We touched on it a bit on last week's podcast on inflation, so I think it was a topic that we've had lots of questions on, and we thought we'd bring it up and sort of bring some of that, just bring some content to it in this week's podcast. I'm joined by familiar faces, so once again we don't need to introduce anyone, but Paul, I'm going to jump straight across to you. We've had quite a high number of people watching the morning market videos this week, which has been great. That's what they're there for in terms of giving people content to what's going on in the markets. It's been an interesting week. Tell us a little bit more, please.
Yeah, sure. So it has been a bit more of a volatile week, should we say, and that's really part and parcel of investing in stock markets. That's what they do. We've seen a bit more weakness in US stock markets, and that's really on the back of interest rates being guided to go higher in order to tame in inflation. We'll come on to that. And so we've seen a bit more weakness there, but the UK stock market has been really positive. It's been up for the third day in a row, and that's been really driven by the banking sector, which typically does well when interest rates are guided higher. So the UK has been an excellent stock market to be invested in this week, and that's something where we've been overweight in the portfolios. European stocks has been a little bit more mixed. Good performance yesterday, and that's really been driven by company earnings season. So we're currently going through what they call earnings season, where companies release their latest financial accounts for the previous quarter. So that's getting a lot of attention. We're seeing some good numbers coming out, so that's helping to improve sentiment in what has been a more volatile week. In the bond market, we have seen a little bit of weakness because of interest rate expectations have been rising, and typically bond yields go up, so bond prices come down. So a bit more volatility, but it's all part and parcel of being invested in the stock market, and really markets reacting to economic normalisation, because you've got strong economic growth. Interest rates typically go up higher when you have that environment.
I think it's interesting because you get that. I think the key thing with True Potential in terms of using the applications and the website where you can see valuations on a regular basis of your pensions investments. I think it's key not to realise that not to realise that it's a long-term investment. When we're advising, Neil and I specifically, when we speak to clients, one of the first questions we ask for is when do you need access to this money? And if it's anything less than probably 3 to 5 years, which is a conversation, you actually say you're probably not right to invest. You've got to think of a long-term basis.
Absolutely.
Really don't take a week in isolation. If you think about last year with COVID, you might be able to give a little bit more on this. What was it? Are we last year? It kind of feels that long ago now. What year? It was 2 years ago.
2022.
2 years ago. We kind of look back at the drop there, and now look, where in terms of March with the markets,
fantastic returns.
And then April just returned straight away. So you've got to look at that long-term basis, don't you?
I think it's important also, you've got the technology. You see it and you see some weakness, but for me, I see that's a great entry point. And I think when you've got something like ImpulseSave to utilise and capitalise on that, you can get a little bit of money in at good prices.
I think that's a really valid point, actually, because it was something I did on Monday. It was the first thing I did when I came in, because I've been I normally phase my money in on a sort of regular direct debit basis into my ISAs. But I took the opportunity this week when the markets dropped to impulse save and maximise my ISA contribution for the year, and rather than wait till he's sort of dripping it over to March. And the reason why I chose that is because I thought actually here's a great opportunity to buy. I think it's just a valid point in terms of units cost less at this minute in time.
Absolutely.
Not too much less, but they do cost less. It's worth an opportunity. I think just let's remind our viewers about impulse save, Rebecca. Like, how do you do that? What does that mean on the apps and on the website?
So impulse save's a really great way if you want to invest quickly, if you want to get your money in the markets quickly, if you know how much you want to invest and you don't feel that you need to have that sit down appointment with your financial advisor. You can open up your phone, so if you've got iPhone or Android app, touch of a button, just like making a purchase online with your debit card information. Remember your card for next time, and you can put anything from £1 upwards in via impulse save, also available through the web as well. So really quick, really easy way for clients just to get their money in.
Yeah, especially when it comes to ISA season that's coming up to an end in terms of tax year end and pensions. Something that we, I remember back in the day, you'll remember back in the day, Neil, you probably had to go to people's houses and get briefcases full of cash, but back in my day it was you had to send checks in now, so it kind of does show you the advantages of good technology.
Yeah, we are seeing an increase certainly with the central clients as well, as you see the increase in calls coming towards the tax year end to say, I want to maximise my ISA. And the good thing is a lot of people don't have time on the move, and so what they can do is just go onto the mobile and think, I want to fill up my ISA allowance, let's do it by impulse save, and just do it straight away. And like you said before, it's really quick, it goes into the market really quick.
Yeah, no, I agree. Okay, we'll get back to the topic of the session today, around inflation and interest rates. So I think, Neil, I'll pass over to you on this one. I think it's actually quite important to say to people, how is inflation measured? Just to give
so inflation's measured on sort of like what we call a basket of goods. So your goods and services that are typically within the economy. So it could be cars, it could be typical stuff like groceries. That's measured on a yearly basis. Inflation at the moment is quite high. It's 5.4% and probably expected maybe to go up a little bit more, which Paul could probably talk about later on. But yeah, that's how it's measured. It's your overall sort of basket of goods. So what you would pay now for a product is maybe in relation to the current 5.4% interest rate, was probably worth less last year or the year before or historically 10 years ago. But it's measured constantly, and it does have an effect on the purchasing power with your money. So if you have £10 now and you want to buy maybe some groceries, you might not get as much as for that £10 with a high inflation rate as what you typically would do.
And I think this is you hit a key point there, Neil, which is the value of money, in terms of actually how it is important to not sit on cash, because actually the higher inflation, the further eroding your cash will get over a period of time.
Yeah, that's right. Yeah. So the higher inflation is, the less you're going to get for your money, basically.
Yeah, definitely. And I think we've all noticed it in our day-to-day lives. I was one of them unlucky ones where my gas and electricity supplier, I think probably most people in the room probably had a similar situation, went bust. I'm now with British Gas, which is literally 6 months ago I changed from British Gas to this company where I had a tied-in rating. And now I'm paying double the price, which is not funny really, but it's...
I think, to bring it relatable to everybody, I was just doing a bit of research online last night, as I like to do. Price of a Freddo in year 2000, what do you reckon?
I need to work out how old I was. So I was 14.
I'm going to go 10p.
10p?
10, I think it was 10 or 15, but I'm going to go 10.
I'm actually going to go lower than that.
I'm going to go lower. I'm going to go
5.
I'm going to have to... I can't... It's always rounded up, so I'm going to go 5 as well.
Well, it was 10p.
Oh.
Okay. Today, what do you reckon?
Oh.
20p?
Yeah. 20.
25?
26.
26.
26p.
Oh,
so
according to Tesco's.
Tell him it's the Freddos.
Yeah, exactly. It's just what to say.
And then the other one I was looking at, Big Mac, which is one of my favourites. So if you're year 2000 again, what do you reckon? How much a Big Mac? Just for the Big Mac, no fries or side drink.
Just for the Big Mac.
I would say £1. I don't eat Big Mac. I don't eat McDonald's.
No,
I might shock you. I know I look like I do, but I don't.
Could you get a Big Mac for £1? I'd say I don't know. I'd say £2. Is that too high?
I've never ate a Big Mac in my life, but I'll say £1.
I was going to say you're a
I'm
vegetarian. We should have got a
I've got no
vegetarian burger.
context on it.
So £1.70
All right.
Yeah.
today.
Yeah. All right. Okay. On that basis, 260.
260.
About £3. I don't know.
330.
330. Wow.
There you
There's
go.
a lot.
There's inflation.
So
for you.
almost double.
Yeah.
We're talking 22 years ago. You see the difference of it.
Yeah.
And I think that's actually really important. It just shows you do need to, if you have 100 grand in the bank now and it's in the future and you don't, it's not
So
getting any growth.
the erosion of your wealth,
Yeah,
basically. So your £100,000, 10, 20 years ago isn't going to be worth as much as it is today.
Yeah, it's vital. I think, Paul, on the back of that, it's probably worth just explaining, how do we as a fund manager, managing people's money, offset against these sorts of things in terms of inflation?
Well, I think you've got to be have a wide range of different asset classes that you can utilise, and some are better at protecting against inflation than others. Equities, in general, are a good way to do it, but we try and be a bit more targeted than that, and we look at things such as energy stocks, we look at financials, we look at material companies as well, and they typically do a lot better when inflation is rising. We also look at other assets outside of equities. In bonds, you can get sovereign bonds that their interest rate payments that they pay are linked to inflation. So as inflation goes up, those interest rates go up, and so the value of that asset actually goes up as well. We also look at other assets, alternative assets as well, such as real estate and infrastructure products, which their underlying contracts are also linked to the rate of inflation. So it's about being diversified, having different opportunities and different assets to go to when the regime changes and you get inflation in the system, which we do have today, as Neil mentioned.
I think that's really key. We talk about diversification, obviously, on everything we do, because it's a big sort of part of our portfolios, but the point of the diversification is if something happens within one asset class, as you say, then you've got the opportunity to offset that against other asset classes, and it's where you kind of, if you're looking at the performance of markets, whether going up or down, you'll not, your portfolio won't necessarily fully reflect what that market does.
Absolutely, it's take the US equity market this year has been a challenged place to be, but we're not just invested in US equities, we're invested in European equities, UK equities, alternative asset classes, bonds, and having that diversification helps smooth that journey for the clients. And I think that's really, really important, and that's why we offer it.
Yeah. So let's just go back to measuring your own money against these sorts of things in terms of how am I beating inflation, which is a key thing in terms of we're all investing to get above inflation, so your money's not eroding. So how can clients measure that, Rebecca, on the technology?
Yeah, so I think it's important to have some really easy, simple tools to measure it, because it's quite hard if you're going to sit down and try and do all the maths yourself. But one of the things that the site does is it allows you to key in a goal, and you can then add to that goal a end date, so when is it that you want to access that money again. If it's a pension, you can look at that as a monetary value in terms of how much do you want to pay yourself as a salary. And you can start to then apply inflation, you can start to apply growth rates as well if your fund's been invested in the market, and it's going to give you a more accurate picture of where your money will actually be and how much you'll need to get the same buying power that you've got now. So it's no good saying I want £20,000 in today's money. You need to look at what will that be worth.
So I think it's a good point, is what Rebecca said. You can change the inflation rate on that, so that the current rate at this moment will give you, and the technology will work out that projection to see what you'll actually get, and maybe if you do have a shortfall, how much that shortfall is and how you can address it, and things like impulse save as well will help.
What do you do, Neil, when you advise clients initially? So if someone comes up to you today and says, I want to transfer my pension, or I've got some money I would like to invest with you, when you're setting these goals that we talk about all the time, how would you sort of bridge that with a client to remind them of actually why this is important?
Well, the technology is really important, and Rebecca's customer care team are great in dealing with those concerns as well. But what we would typically do is most importantly is take the goal, take how many years they wish to invest. That relates to the goal because that'll give us a good idea of how many years they wish to invest in. Typically, it is 3 to 5 years. Normally, is a minimum sort of value, because you're seeing them returns and you're seeing the portfolios really work to get that in there. But yeah, we talk about goal. We talk about what they want, how much a monetary amount maybe is what they want, and then what they can do to bridge that gap if there is a gap. How much they can contribute monthly, which is really important. I think we've talked about in the past. About how people who have larger pension pots now of maybe £300,000, £400,000, have typically invested monthly. They haven't necessarily put in large amounts. They're typically very good investors. Just going back to the point that you said before about sticking in the market as well, which is really important. When March 20 hit and we had that dip with COVID, we had a few client concerns to say, the markets have really fallen. Those clients have now seen the benefit of staying invested in the markets because those markets have gone back up. Yeah. There's been growth on there with, from Paul and his team, which is, alluding to the diversification, how it manages inflation, how it manages world events, how it manages different sort of, things like COVID. But typically we would have a conversation with the client, set a goal, set how much they wish to invest, and then also as well take into account inflation rates as well.
Great. Paul, I think it's just a question off the cuff for me personally, because I know you look after a lot of our clients looking at these sort of sessions today are our auto enrollment pension clients, which is obviously a fund that you're heavily involved in. So
yes.
Just getting how do you, when you're having your conversation, when you're looking at the management of the money side of things with the team and Jeff, how do you fit in this? So all of a sudden inflation goes from 2-3% to 5% over the last sort of year or so. What sort of drives your conversation, your decision making?
Yeah, I think when we see inflation rising, which it has done, I think it's understanding why it's rising and what the underlying factors contributing to a higher inflation. One of the obvious ones has been energy, the price of oil, which is a key component in that basket of goods that to measure inflation. So energy's been rising, but we know oil prices don't just continue to rise at the rates that they have done. It's at $90 a barrel today. Will it go to $100? Maybe. Will it go to $200? Extremely unlikely. Yeah. So that eventually will roll off. So we know that. We also look at other components such as wages, not necessarily components, but if you've got higher wages coming through because unemployment's falling, then people are more likely to require, if the employment rates are falling, the labour market, the pool of labour out there is falling, so people can demand higher wages. They have more income, they're more likely to go out and spend. It fuels that demand, so people can increase prices. So we look at that. We look at other components such as rental prices. So rents is actually about 30% of the basket in the US, so a big component. We know that the housing market has been exceptionally strong over the last 2 years. In the US, house prices on average went up 20%. And rent prices tend to lag by about 9 months. So we know that's coming through. We also know that supply chains has been a big issue over the last 12 to 18 months. We take a view and discuss whether those supply chain issues are going to improve. We saw Apple yesterday report, and they discussed that the supply chain issue hasn't been as big as a problem as they first thought. So we have these different conversations about the underlying components and then build it up to see whether this inflation is going to continue to rise or it's actually going to start to moderate. And that's actually our view. We expect it to moderate going forward because energy is going to start coming off and improvements in the supply chains.
It's really interesting, the forward thinking, isn't it? The forward thinking of actually going, we know that it takes 9 months for rental incomes to in America. That's the key of having lots of people upstairs and lots of data and understanding that, which allows you to make better informed decisions. You obviously can't predict the future, but you can base it past on history. Okay, so just moving a little bit away from inflation, we're actually tying it in for it. So the governments the governments have to control inflation in some way, because it can't be out of control. And one of the ways to do that is with interest rates, which is set by the Bank of England in the UK. So tell me a little bit about, I suppose, what are the world thinking about in terms of trying to control these interest rates? They're very low at the minute. They've notoriously been low for a while.
Yeah.
I'd expect it to go up, but what's your view on it, Paul?
Yeah, absolutely. There's been a lot of discussion around inflation, and quite timely we heard from the U.S. central bank, the central bank that gets the most attention by far, and they've discussed that because you've got high inflation, we need to start raising interest rates. So they've guided that they're going to increase interest rates for the first time since March 2020 to help control the inflationary pressures. They've got 7% inflation in the US, we've got 5.4%. We've already seen the Bank of England raise interest rates, which they did in December, going from 0.1% to 0.25%. So it's that path that they're now on of increasing interest rates because the economy needs to, from an inflation perspective, but the economy's in good health. Having interest rates at nearly 0% is not normal. It's not normal. It's never done. Only at exceptional times. So having interest rates a little bit higher is just part and parcel of normalisation, getting back to where we were pre-COVID. So it's a good sign. So
there's a challenging question. Give me a prediction. What do you think will happen over the next year with these rates? Because you're right, 0.25 is incredibly low still. So
if we take the US, where a lot of the focus is because it just has a greater impact on financial markets, we're expecting interest rates to be increased at least 4 times. So it's currently so it'll go over 1% in the US if that comes through, and that's just given the strength of inflation, but also the economy can afford to increase interest rates that much. So that's interesting. That's our expectation. And I think there's obviously benefits of low interest rates. We discussed this in last week's podcast, Neil. I think you can tell that by every time I go to renew my mortgage, which is currently, I said last week, I got a 1.24% interest rate on my mortgage. So there is some benefit to that low rate now. So if you are coming to a sort of end period on your mortgage, it's worth considering your options.
Yeah, certainly. Yeah, I mean, we get a lot of questions in the central advice arena about should I be remortgaging now, or should I be buying a property? Remortgaging rates are obviously quite low at the moment, very low, lowest I've ever seen for a long time, and a lot of people are doing that. Whether or not that will change in the future, I would imagine. Some predict that there will be some sort of property crash with regards to prices, because if you look at the property market at the moment and you look at how much prices are, they're very, very high at this moment in time. It's a very high market, and an estate agent is normally a good indicator of how high the market is. So normally you would have a price for, say, a house for £300,000, and you would say £300,000 or offers in the region of. You never see offers in the region of anymore. It's always 300,000 or over. Yeah. So you can tell it's a market which is, the housing market is high at the moment. But then again, that's related to, remortgaging rates, which are very low at the moment, and a lot of people are jumping on the bandwagon and doing so to take advantage of a 3 or a 5 year deal.
Mm-hmm. Yeah, no, I think it makes sense. I said this last week, but my auntie's just tied herself into a 10-year deal. Yeah, which is, it kind of makes sense really when you think, you go, wow, we offered a 10-year, but I think that was max market was 5. But it just shows you when you kind of look at these things, when you're forward thinking, you think actually interest rates probably will most definitely go up. Yeah. Then actually it's not a bad thing in terms of tying yourself in. I said 3 or 4 years ago, tie myself in a mortgage saying they're not going to get any lower. And then guess what? It's just crazy, I think.
Very low rates at the moment.
Yeah. So if we just kind of tie this up together, I think the key thing, inflation's happening. We know what's happening. We can see the sort of increase. And I think the key, I think we all agree on, would be ensuring that you're invested. That's the point in being invested, is to try and match up beat inflation.
Yeah, I was just going to say now's the perfect time, because if you take COVID as an example, there's been a record level of savings over the last 2 years because nobody has been spending any money. There's been obviously an increase in, you know, maybe things like Amazon getting delivered to your door. I know I have personally, but people have generally saved and they've put a lot of money away. The problem that you've got is it's sitting in your bank, and when we've discussed low bank rates, and we're talking about inflation, that money isn't going to buy you what you think it's going to buy you in a couple of years' time. So why not get it invested? Because, you know, things like the portfolios, the true potential portfolios, which Paul talked about as well, the diversification is going to make hopefully that money work harder for you.
I think, you know, it's people's perception that just putting your money in the bank account is safe.
Yeah.
Yes, it'll be there.
Yeah.
And it'll be that same value, but the risk that you're taking is in the inflation, the impact of inflation, and eroding that real value. So you've got to really think about, is it the best place?
Yeah, no, I totally agree. And think about, you know, how much, if you do need cash in your bank for emergency funds, which we always recommend between 3 and 6 months as an advisor, start a thing actually. You know, and I'm guilty for this sometimes where I go, I should probably invest a little bit more of that cash in the bank because I'm losing out on it. We have conversations about this quite regular.
Yeah.
It's always key to say, actually, how much do I minimally need in that bank that'll make sure that if something happens, the boiler breakdown fund or anything, I can get it. But I've got, my money's grown and as I said, at the minute it's an opportunity market, so a bit lower. It's an opportunity to buy.
Yeah, you should always keep yourself a rainy day fund, you know, for the emergencies, like you said, for the boiler or, you know, if you need a new car, whatever that may be. But generally, as agreed, we do 3 to 6 months emergency funds, and then anything else over that, really, if you've got excess funds in there, you should be looking at it thinking, well, actually, given the bank rates, that's not really working for me.
Neil's just, I don't even know, he's told me about 15 times now, but he's just spent his emergency fund on a new kitchen. So
a new washing machine
and a new washing machine.
Machine,
I got a message on Monday, which is really exciting. I've bought a washing machine, and you can turn the washer on with your app.
Yes.
So it's
can you?
Yeah.
Really?
Yeah. He's already got one.
Yeah, in fairness I do. But we should maybe turn your washing on now, Neil, if you can get your app out and do that.
The washing machine has not been delivered yet.
Oh no! So we can be spinning in
there
someone's
you go.
fan.
There you go.
All right, we need to get that. Okay, well we'll wrap up, ladies and gents. I think in true potential style. Neil, you won't be washing at the weekend because you haven't got a washing machine.
That's right, yeah. So I'll be washing in the street. I'll be doing my washing in the street.
Which is pretty normal for
pretty normal for County Durham.
Yeah, I was going to say. But you'll be enjoying your new kitchen.
Yes, yeah. So enjoying that. But I'm going to venture out, I think, at the weekend for a bite to eat in Durham. So I haven't been in Durham for a while. So I might go and try. There's a new restaurant in Durham, so I'm going to try that out.
Oh, okay, great. Becca?
I was actually supposed to be looking at getting a new kitchen,
Oh.
and then the guy sent a message and cancelled the appointment. So
Why don't you go to Neil's house and look at his kitchen?
see if his is nice.
Yeah.
He's the
Right.
same guy.
Yeah.
I definitely want one of those washers though. So not a lot. I've got a nice, relaxing weekend. We're just out and about with the dog and things like that.
Plenty of walks again.
Mm-hmm.
Good stuff.
For myself, well, I'm in need of a nice, relaxing weekend, but I won't be getting one of those. I'm going down to my girlfriend's parents
Oh,
in Sheffield.
are you trying to say it's not relaxing going to your girlfriend's parents, Paul? Like,
If
everyone live on video
I'm
here.
not going to say anymore.
Can we make
Not
sure we
gonna
get
say anymore.
our email address afterwards and we'll send her a live copy of our future
No.
son-in-laws? It'll be
Steady.
Yeah, good stuff. I'm sure that'll be good. Well, I have my wife's in isolation till Saturday night.
Yeah.
So kind of hopefully she'll get out on Sunday and we can actually get something done. I feel like I've literally, because obviously as people know, I had COVID for 2 weeks and then another 2. I feel like I've been locked in the house since January. So it's been a bit of a crazy time as it has for many others.
Still January.
Well, oh yeah, it's still January. Well, it might not be by the time we publish
COVID
this.
has affected you in other ways, hasn't it?
yeah, it certainly has. I feel like who's it? It's Henri touching
That's right,
his
yeah.
knee there.
Yeah.
Appreciate
Good.
that, Neil. Yeah, good, great. Well, thank you very much, everyone. Thanks, everyone. I think it was a really good session. Hopefully, that's give you a little bit of flavour and content. And please do the usual: watch, subscribe, and thank you very much.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.